You're here because you want to get straight to the point, right?
Mm-hmm.
To really figure out what makes businesses tick value-wise.
Mm.
Well, today, we're going to give you that core understanding of two concepts that are, well, fundamental, but also often a bit confusing. Goodwill and intangible assets.
Yeah, they can be tricky.
Think of this as your express elevator ride to understanding a really key piece of the financial world.
Exactly. We've gone through Goodwill and Intangible Assets.pdf, pulled out the really important stuff you need.
Right.
Our mission here in this deep dive is to sort of demystify these assets you can't really see, explain the accounting side, and show you why they're so important for anyone looking at a business.
And just to give you a quick sense of why this is so relevant, I mean, think about the huge companies today. So much of their value isn't tied up in factories or machines.
Not at all.
It's in their brand, their tech, their customer base,
Yeah.
all intangible stuff. It's kind of like the hidden engine, driving things forward.
That's a great way to put it, the unseen engine.
Okay, so let's start unpacking. When we talk about intangible assets, what's the basic idea there?
Okay, fundamentally, an intangible asset is, well, it's identifiable, it's non-monetary, and it doesn't have physical substance.
Identifiable.
Yeah.
That sounds key. What does that mean exactly?
It's crucial. Identifiable means you can separate it from the company, like you could sell it or license it, rent it out, whatever, or it comes from some kind of contract or legal right.
Okay, got it. So let's make that real.
Yeah.
What are some actual examples from the source material? What kind of things fit this definition?
Well, the document points to stuff like brand names, huge value. There's sometimes trademarks, customer lists, which, can be worth a fortune.
Right.
Also software, patents protecting inventions, even the money spent making movies, all identifiable, none of them physical.
The stuff you can't stub your toe on. Okay, but what about things that feel intangible but don't get this label in accounting? Is there anything like that?
Yeah, that's a good point to clarify. Think about inventory. It's sitting there, waiting to be sold. Its value depends on the market, sure, but it's still a physical thing. So under these rules, it's not an intangible asset.
Gotcha. Inventory's out.
Yeah.
So we know what they are. How do companies handle the costs? Like if they create these assets themselves or buy them?
Right. So if a company develops an intangible asset internally, the cost treatment kind of depends on the stage.
Okay.
When they're just exploring ideas, the research phase, those costs usually get expensed straight away. Hit the profit and loss.
Makes sense. It's speculative.
Exactly. But if it moves into the development phase, they're actually building something specific, then those costs can be capitalized, put on the balance sheet as an asset.
Ah, okay. But there are rules.
Oh, yeah. Strict criteria. You basically have to show it's technically possible to finish it and that the company plans to and can actually use it or sell it.
Right.
Like software, for example, the rules might shift once you've proven it works, maybe got a prototype going, then you can start capitalizing costs.
Okay, so research is expensed. Development might be capitalized if it meets the tests. What if a company just buys an intangible asset from someone else, skips the internal development?
Then the starting point, the initial accounting, is different. If you build it internally and meet the rules, it goes on the books at cost what you spent developing it. But if you acquire it either on its own or, say, as part of buying a whole other company, it usually gets recorded at its fair value when you buy it.
Fair value. So what it's worth in the market at that moment.
Pretty much, yeah. What a willing buyer and seller would agree on.
Got it. Okay, so that's intangible assets. Now let's tackle the other big one, goodwill. What on earth is goodwill?
Okay, goodwill. It is a type of intangible asset, but it's very specific, and this is super important. It only comes up when one company buys another business.
Only in an acquisition.
Only in a business combination, yes.
Yeah.
It basically represents the future economic benefits you expect to get from the assets you bought, but which you can't pinpoint and recognize separately. Think of it like the extra price, the premium, a buyer pays over and above the fair value of all the identifiable assets, tangible and intangible, that they're getting.
So it's the mater, the magic ingredient, the reputation, the synergy, that kind of thing.
That's a good way to think about it. The reputation, maybe the skilled workforce working well together, the good location, the customer loyalty, stuff that adds value but isn't a separate line item asset.
So crucially then, it only appears when there's a deal, a merger, an acquisition. You can't just build up a fantastic reputation and put goodwill on your own balance sheet.
Absolutely not. The source is really clear. Goodwill is only recognized when you buy another business. Internally generated goodwill doesn't get recognized.
Wow.
Your own great brand or loyal customers add value, obviously, but it won't show up as goodwill on your financials unless it came from an acquisition.
That is such a key distinction. Okay, so when company A buys company B, how do they figure out the actual number for goodwill?
It's basically the leftover amount. You take the total price, company A paid the cash, stock, whatever the consideration transferred, and you subtract the fair value of all the identifiable net assets they got.
Net assets meaning assets minus liabilities.
Correct. Assets minus liabilities, all valued fairly. So if company A pays $10 million for company B, and company B's identifiable net assets are worth $8 million at fair value.
Then the extra $2 million is goodwill.
Exactly. That $2 million goes on company A's balance sheet as goodwill.
Okay, it's the premium paid that you can't attach to anything specific you bought. Now, accounting treatment, we hear about amortization, impairment. How do these apply here? Do goodwill and other intangibles get treated the same way?
Yeah, no, this is where they really differ. Big difference here.
Okay.
Intangible assets that have a definite limited lifespan, a finite useful life, like a patent that lasts 20 years, those get amortized.
Amortized meaning?
Meaning you spread the cost out as an expense over that useful life, like depreciation for tangible assets, but amortization for intangibles.
Got it. Gradual expensing. What about goodwill then?
Goodwill is different. Goodwill and some intangible assets that don't have a foreseeable limit to their life, indefinite lived intangibles, like maybe a very strong brand name, they are not amortized.
Not amortized at all. So the cost just sits there.
It sits there, but it gets tested. They have to undergo impairment testing at least once a year.
Impairment testing.
Yeah, or more often, if something happens, some event or change, that suggests its value might have dropped.
Okay, impairment testing sounds a bit subjective. What does that actually mean they do?
Well, it involves comparing the value of the goodwill, or the indefinite-lived intangible, recorded on the books, its carrying amount, with its current estimated fair value, or what's called its recoverable amount.
Recoverable amount.
Yeah, essentially what the company could get back from it, either by using it or selling it. If the book value is higher than this recoverable amount, then they have to recognize an impairment loss. They write down the value of the asset on the balance sheet, and that loss hits the income statement.
Ouch. Okay, so boiling it down, the big dividing line seems to be this identifiability thing we started with.
Absolutely. That's the core difference.
Yeah.
Can you separate it, value it on its own, maybe sell it? Then it's an identifiable intangible asset.
Right.
Goodwill is what's left over in an acquisition, the value you paid for that you can't tie to a specific identifiable asset.
And the accounting follows from that.
Yeah.
Amortization for finite life identifiable ones. Impairment testing for goodwill and indefinite life ones.
You got it.
Now, you mentioned useful life for those amortized intangibles. How on earth do companies estimate that? Especially for something like, say, a customer list or a brand. It's not like a machine wearing out.
Yeah, estimating useful life takes quite a bit of judgment. It's not always straightforward. The source mentions looking at things like legal or contractual limits. A patent's expiry date is pretty clear.
Sure.
But also how long they expect to actually use the asset, how fast technology might make it obsolete, what competitors are doing, market stability, lots of factors.
And what about its value at the end? Its residual value?
Generally, for intangibles, the assumption is the residual value is zero.
Oh, zero. Really?
Yeah, unless there's a firm commitment from someone else to buy it at the end of its life, or there's a really active market where you could realistically sell it then. Otherwise, assume zero.
Okay, that makes sense. Technology especially moves so fast.
Yeah.
What if a company spends more money on an intangible asset after they've already got it on their books, like they do a massive brand refresh?
Good question. Generally, any extra spending on an existing intangible after you've initially recognized it just gets expensed as you incur it.
Expensed, okay.
The thinking is the original value should have captured the expected future benefits, but like always, there are exceptions.
Oh.
If that later spending clearly increases the future economic benefits beyond what was originally expected, maybe the brand refresh truly boosts market share way beyond projections, then those specific costs might qualify for capitalization. But it's a high bar.
Right. Needs to be a significant enhancement. Okay, this is really clarifying. What about R&D? Research and development spending. We hear that term all the time. Where does that fit with intangibles?
R&D has its own specific rules, closely related to this. Our source says costs in the research phase, The early exploratory stuff are almost always expensed immediately
Why that?
because it's just too uncertain at that stage whether anything valuable will actually come out of it.
Makes sense. And development.
Development costs, as we touched on earlier, can be capitalized, treated as an asset, but only if you meet those tough criteria. Prove it's technically feasible, you intend to finish it, and you can use or sell it.
I got it. Research expense, development, maybe capitalize if criteria met. Okay, we've covered a ton here. Let's bring it back to the listener. Why should you tuning in actually care about all these distinctions? Goodwill, intangibles, amortization, impairment. Sounds like accountant territory.
It might sound like it, but honestly, understanding this stuff is surprisingly practical. I mean, if you're trying to figure out how healthy a company really is, a big chunk of its value on paper could be tied up in these intangible assets and goodwill. Knowing how they're accounted for, are they being steadily amortized, or are they sitting there potentially waiting for a big impairment write-down? That gives you a much smarter read on the company's real financial situation and maybe its future.
That's a great point, especially for, say, tech companies or pharma companies, where patents and software are everything.
Exactly. Understanding how those core assets are valued and treated on the balance sheet is absolutely critical.
And also, when you read about a big merger, right, and they talk about the huge amount of goodwill created, understanding what that is helps you think critically about whether the buyer may be paid too much.
Precisely. Or if you're involved in valuing any business yourself, or even just trying to understand why some companies command such high prices, especially in fields driven by brands and innovation, intangibles are a massive part of that story.
They might be invisible, but they represent real potential value.
Very real future economic potential. Often, they're the absolute core drivers of long-term success.
All right, let's wrap this up then. If you take away just a few key things from our deep dive today, what should they be?
Okay, the essentials are intangible assets identifiable, non-physical, separable, or from legal rights. Think brands, patents, software.
Right.
Goodwill, also intangible, but only from buying a business, representing that extra value paid above identifiable net assets.
Crucially different.
And their accounting is different too. Finite life intangibles get amortized over time. Goodwill and indefinite life intangibles don't get amortized. Instead, they get tested regularly for impairment for potential write-downs.
Identifiability, source, acquisition versus internal, and accounting, amortization versus impairment.
Got it. So the next time you run into these terms, reading financial news or looking at a company report, you'll have a much better handle on these, well, invisible but powerful forces shaping business value.
Hopefully, yes. And that brings us to maybe a final thought for you to chew on. We live in this economy now that's so driven by knowledge, by brands, by tech.
Increasingly so. Intangible assets are just becoming more and more central. So think about how we value these things, how we account for them. Might these methods need to evolve even more in the future? And maybe, what other hidden values do businesses have that we aren't even properly capturing yet?